Hello, everybody. Thank you for joining us tonight with the webinar. I do apologize first and foremost for the late start. I'm really sorry we're starting 9 minutes late. I do apologize about that. I had some technical difficulties with my laptop just before the live webinar and stream was supposed to begin. Essentially, there's a technical issue which has since been resolved. But the good thing is now that technical issue is out of the way, the webinar itself should run smoothly. So allow me to introduce myself. My name is David Madden. I work as a market analyst for Equity Capital in London, and Equity Capital is one of the many firms within the overall equity group. Obviously, we have Equity Nigeria in Nigeria and FX Pesa in Kenya. Now, what I'll do is I'll quickly kind of run through a few charts, talk about some of the big macro markets, the major popular products, talk about the big fundamental news and the big technical news that's driving the markets. And then afterwards, if you have any questions at all about what I'm covering, feel free to ask away. If there are any markets that I haven't covered in the kind of rundown that I'm going through, just feel free to say, hey, David, I haven't seen you take a look at dollar yen. Would you please take a look at that, or whatever it might be? So absolutely feel free to ask questions about what I'm covering a particular topic. If you don't know, just ask away. And if there are any questions you have outside of what I'm covering, please keep those to the end. And also, if there's any markets that I haven't covered that you want me to take a look at, once again, please feel free to ask, but please keep those questions to the end. So I hope you can all hear me okay, and see the screen okay. So what I'm looking at now is the chart of gold. And we can see the price action of gold in the medium term has been a bit boring, to be perfectly honest. It's been trading in a fairly small range. But if you take a look at the longer picture for gold, on a more longer term basis, gold has been rising over the last few weeks, but hasn't really kind of been moving in a clear direction, either higher or lower. It seemed to be kind of more range bound in the last couple of sessions. And to be honest, I find it a little bit boring. So what's been going on with gold? A couple of things have been going on with gold. First and foremost, the strong US dollar. Gold, like other commodities, is traded in dollars. So whenever the US dollar is strong, that typically puts downward pressure on gold. Conversely, whenever the US dollar is weak, we typically see gold rise. Essentially, the reason why this is if the US dollar is weak and you're coming from the UK and you have British pounds, or you're coming from the Eurozone and you have euros, that your local currency buys more American dollars because the dollar is cheap, and therefore it becomes, you can buy more gold with the same amount of money, which obviously is traded in dollars. So that's the inverse relationship between the two assets. What's also a factor is the risk-off mood in the markets. We've seen recently declines in stock markets. Admittedly, not as bad as what we saw perhaps in the middle of May or in April, but we have seen some pretty bad bouts of selling in stock markets. And gold is a sort of an asset which typically does well whenever stock markets are falling. Because if stock markets are falling, people tend to kind of go, right, stocks are higher risk. I want to lower my risk, so I'll cash out my chips on stock market on stocks, and I'll invest my funds in an asset that is deemed to be lower risk, such as gold. So when stock markets are falling, gold typically rises. But we're in this unusual situation whereby stock markets are falling, but at the same time, the US dollar is strong. So it's sort of being caught between a rock and a hard place, in that the strong dollar is preventing gold from moving higher, but at the same time, the flight to quality play, the fact that the stock markets are weak, is kind of almost putting an invisible floor beneath gold. So it's sort of why gold really hasn't retested 1783, but at the same time, it hasn't retested 1828. To be perfectly honest, I don't have a particularly strong view on gold at the moment. It's sort of dilly-dallying around or meandering around these moving averages here. By the way, this is a 4-hour chart that I'm looking at, and this is the 100 period moving average, the 50 period moving average, and the 20 period moving average. And as you can see, the moving averages are all kind of converging on each other, and also the price of gold is kind of hanging around those moving averages. So there's no clear direction, but as far as I'm concerned, even though the short-term price action for gold seems to be lower, the more recent price action tends to be lower, but at the same time, we can't ignore the fact that the longer-term trend for gold is certainly higher. And typically, not always, but typically the longer-term trend supersedes the short-term trend. So as far as I'm concerned, if gold continues to hold above well, ideally this trend line along here, but if gold continues to hold above 1828, I suspect the longer term upward trend will continue. A rally from here could see it retest 1873, and a break above that could see a target 1892. Now, if we have seen, one of the issues that's also been impacting gold is the rise in bond yields. Now, the US 10-year yield, the yield on the US 10-year government bond, the last time I saw was around 3.05%. So the overall yield or return from holding the 10-year government bond by the US, issued by the US government gives you return of over 3%. Now, this time 2 years ago, when interest rates were zero and we were kind of we were just, we were kind of right in the height of the pandemic, bond yields were extremely low because interest rates were extremely low. This time 2 years ago, the US 10-year yield was 0.7%. So the return you got 2 years ago from that same asset was 0.7%. It's very little, I know. Whereas nowadays the yield is up over 3%. Now people start asking themselves, why would I hold gold, which, although has a long term, which is a typical flight to quality play, it doesn't give you any returns. It doesn't give you a yield like a bond. It doesn't pay you a dividend like a share, and it doesn't give you interest like cash on deposit. Now that interest rates are rising and bond yields are rising, some people are shying away from gold because they're thinking to themselves, I should have my money elsewhere. So with that in mind, the more short-term trend for gold is lower. If we do see a break to the downside in gold and we break below this trend line here, we could look to retest the lows of early June in at 1828. And if we break below that, that would be fairly significant because we'd then be taking us back to levels last seen in mid-May, which would take us down to 2.5 3-week lows. If we break below 1828, I'd then be looking down towards 1810. Then below that, I'm looking down towards 1800, and then below that down towards the lows of mid-May, which were in around 1888 thereabouts. And keep in mind, the low that was set in mid-May was in fact a multi-month low. Taking a look now at euro-dollar. So we have an update from the European Central Bank today, and the ECB gives a fairly clear signal that they're planning on hiking interest rates by 0.25%, 0.25% next at the next meeting in July. Now, this was fairly well signaled. We can see here that euro-dollars enjoyed a fairly decent rebound, a fairly decent rally from mid-May onwards. If we look at the ground move covered from in mid-May, it dropped to a 5-year low. Up until late May, it was, it went from being below 104 to close to 108. So we're talking a rally of almost 400 pips in a matter of weeks. This is down to a couple of factors. Partially, the US dollar was very strong and has cooled a little, but also because the fact in around this period here, the European Central Bank, various different central bankers started to suggest interest rates are going to be hiked in July. Today's meeting, rates are kept on hold, meeting expectations, but they gave the kind of almost like today's meeting was the kind of the final hint to say rates are being hiked by 25 basis points in July. We might even do a hike of 50 basis points in September, depending how things go. So we know in the next few months, between June and July, we're going to a couple of at least 2 rate hikes from the European Central Bank. The first of which will be 25 basis points. The second, at least 25 basis points, maybe even 50. So it's almost as if a lot of good news regarding the hawkishness of the European Central Bank was already priced in to the euro today. And when they turned around today and said, we're strongly indicating a 25 basis point interest rate hike in July, what they're also saying is we're not doing a 50 basis point hike in July, or it's very, very, very unlikely. And with that, we have seen a bit of downward pressure. This is a kind of classic example of, as I say in the markets, buy the rumor and sell the fact. On the run up to today's meeting, the euro rallied in the last couple of sessions. Why? Because people thought the Fed were going to be hawkish. They were hawkish. They weren't extremely hawkish. And then what do you know? People actually sell the euro, essentially bank the profits that they've made for those who bought the euro back, either down around here or down around here or back here in late-ish May. But we seem to kind of have had a fairly large rally here, and given the fact that we're expecting a rate hike next month and possibly a large rate hike in September as well, this could be the beginning of a kind of much broader turnaround in the overall euro dollar. So in the very short term, while the currency pair continues to hold below these three simple moving averages, I suspect that the short-term bearish trend will continue. Moving lower from here, we could look to retest 106.26, and below that, take us down towards 105.87. And then if you go below that, we could be looking ahead down towards 105 itself. I was asked a question here about oscillators. Which are the best oscillators to use? What I like to look at is this. This is the MACD indicator here, MACD, the moving average convergence divergence. MACD indicator measures momentum, the rate of change, and this one here, the RSI, the relative strength index, is essentially a measure. Once again, it's a measure of kind of how quickly a market is changing, and it can give you an indication of whether a market's overbought or oversold. Now, tying in with that question, looking at the price action here of euro dollar, we can see it's moving sharply lower here, these two large red bars here. Looking at the MACD indicator, we can see that momentum has swung from positive territory here, these yellow bars into these red bars here. So momentum has swung from positive territory to negative territory. So it's suggesting that the bulls were in control, the buyers, they were in control. Now the bears are in control. But once again, adding weight to the view that sentiment is negative. The RSI is moving sharply lower as well. Once again, indicating the price bias is to the downside. If you look at periods where the RSI was moving lower, that typically coincides with periods where the price is falling. And then conversely, whenever you see the periods of the RSI moving higher along here, in fact, it's actually in overbought territory, suggesting it's at such a large upward move. It's moving higher at quite an aggressive rate, and therefore that in itself could be a bit of a warning, because if the market's moving too quickly in a certain direction, that could act as a flashing light to say we've kind of overcooked it, as it were. We may need a bit of a pullback. So if you can see here in these periods here, when the market has moved into overbought territory, such as here, it sometimes, but not always, coincides with the market rebounding or pulling back. So these are the two indicators that I typically use: the RSI, the relative strength index, and also the MACD indicator. So this is what I mean about, we've now, on euro dollar itself, the currency pair, we've taken out 106.26. We've now fallen back to a level last seen on the 20th of May. So we're back down to a kind of a 10-day or a 2-week low. That's significant. The RSI is moving lower, suggesting the bias is to the downside, and momentum has swung from positive territory to negative territory. Once again, adding weight to the view, things are going lower. So I wouldn't necessarily use for me, price is by far the most important thing on the screen. It trumps everything as far as I'm concerned. But what I would use is, I would use the MACD indicator and also the RSI as a way of often teeing up my next trade. And what I mean by that is, in the very short term, euro dollar is moving lower, but this bearish move here has to be put in context of the massive bullish move that we saw from here to here. So what I wouldn't be surprised is if in the near term, if we lose further ground on euro dollar, perhaps we fall down towards this area, here around 105.60, or maybe down towards 105.35, something like that. And then we look to kind of move higher and continue on in the next leg higher. So what I mean is, when the market was turning around here, notice how we bottomed to a 5-year low. We had a higher high, a higher low, a higher high, a higher low, a higher high. We built on a steady series of higher highs and higher lows. Fair enough, we rallied the guts of 400 points between mid-May and late May. So don't be surprised if we hand back about 150 or 200 on those points and take us all the way back down towards kind of 105. But we could then use that, say 105, for example, as a base before we begin the next leg higher, if you see what I mean. So I wouldn't be surprised if you have a scenario whereby the market actually kind of, say, for example, falls all the way down to say 105, and then from there begins another leg higher, kind of on in this direction. So when it comes to the MACD indicator and the like, I wouldn't necessarily enter a trade based purely off of what goes on the MACD indicator, but I talked about how the RS or the RSI, for that matter, but the RSI is moving aggressively lower. It's probably the lowest we've seen in quite some time. If RSI moves into oversold territory, that could act as an early warning sign that the recent downward move has become overstretched. Like, for example, we can see here in mid-May, it was overstretched here. It moved into oversold territory in mid-May, and lo and behold, that preceded this major rebound in price. Now, not to say every time a market moves into oversold territory, you're going to see a rebound, but the chances of a rebound increases. There's no guarantees that it will. But if I was to say to myself, how am I going to use the RSI for a trade? I'll be teeing it all up in that we'll probably fall further on in terms of the price of euro dollar, another whatever it might be, 50 pips, 70 pips, even 100 pips. And then at that point, if that is the case, we'll probably be in oversold territory. And then that will be the catalyst. I will go, now I think the market could be turning around. And now I think the more medium-term uptrend is going to continue. Does that make sense? So if we do see a rally in euro dollar from here, where can we go? Well, first and foremost, I've been looking back up towards the peaks that was set today here. And then the next real big level to watch out for in euro dollar will, of course, be the peak that was set in late May. And that was a 5-week high. And that comes into play at 1.0786. And then beyond that, I'm looking back up towards this area here around 109.35. So coming on now to the US 500, the S&P 500. So we fell to, I think it was a 15-month low in late May, in late-ish May on the S&P 500. There's fears about recession hitting the US economy. There are concerns about the rise in bond yields. Once again, going back to what I said a few minutes ago, people are now saying if I can get a 3% return on a US 10-year government bond, which is essentially a risk-free investment, why would I hold shares in that are constituents of US stock markets, such as the S&P 500? There are certain companies out there that pay a dividend, and the overall dividend yield might be 2.5%, 3%, 4%, maybe 5%. But people start to weigh up, well, 2 years ago, when the US 10-year yield was yielding 0.7%, it made sense to have a disproportionately large amount of my overall investment funds in the stock market. Now that bond yields are 3%, perhaps I should have more money of my overall investment pool in bonds, and therefore making certain stocks or stocks as a whole less desirable. So that's been playing into kind of this ever so slight kind of almost a downward trend that we've been seeing here on the US 500. Look at this here. So it's handed back some of the gains that were set in late May. So, looking at the price action, broadly speaking, in the very medium term, things have been moving lower on the US 500. A series of the highs are lower, a series of lower highs. We're below all 3 simple moving averages. The RSI is moving lower, indicating the price bias is to the downside. The MACD indicator is in negative territory, just about indicating that the bears are in control. So while we continue to hold below these 3 simple moving averages, I suspect the more medium-term bearish trend will continue. Moving lower from here, I could potentially see it retesting 40, 46, and a break below that could see us back down towards 39.81. Now, this medium-term slight downward trend has to be put in context of how much ground was achieved between the rally of late-ish May mid-May up until late May, where the market rallied almost 400 points. It was a huge rally. So if we can manage to kind of hold above, say, for example, this area here, kind of in around 40.70, or perhaps down towards kind of 40.50, if you can hold above that zone there, that could act as a kind of support zone for the next leg higher. You have to kind of imagine it as if it could very well be the case that the market does a move like, for example, from here to here is one move. It hands back some of the lost ground, and then after that, it commences the next leg higher. This is what you mean about, this is why I like technical analysis, the study of chart and the study of patterns. You always need to kind of visualize the next move, because an upward trend is defined as a series of higher highs and higher lows. So for all we know, in the grand scheme of things, this is the large upward trend, which really smashed above this peak here. It took us back up to a multi-week high here, almost a 1 month high. It's been drifting a little lower. We haven't seen new highs or new multi-week highs, but at the same time, the market hasn't really fallen a huge amount either. So it's possible the market's just drifting a little lower, kind of sideways trading before potentially the next move higher begins, or potentially the next leg lower begins. Now, as I said, if in the short term, I suspect we're going to drift lower. But if we do get a decent break to the upside, where can we look to target? Well, I'm looking at target this peak here at 41.69. And then beyond that, the big one to watch out for will be the highs of late May, which of course were kind of 3-week highs, almost 1 month highs. And that comes into play just north of 4,200. Looking at the UK 100, the FTSE 100, there were concerns for the health of the British economy. The British economy contracted ever so slightly in the month of March. Inflation's at a 40-year high in the UK. We recently saw, some economic indicators like the services sector, which were decent, had a fairly decent revision, but were readings in the low 50s, considering 6 months ago, 9 months ago, these ratings were either in the high 50s or even the low 60s. So the heat is coming off the British economy, like many of the economies. What's also going on is a fall in metal prices. Excuse me. The FTSE 100 has a disproportionately large amount of mining companies and oil companies in its composition. So if you ever see a big move in metals or oil or both, that can often influence what's going on with the FTSE 100. So the FTSE 100 was in fairly decent shape, but it's endured a fairly large sell-off the last couple of days, largely because we saw a lot of weakness in industrial metals, copper, silver, platinum, and the likes, in the past 48 hours. So the weakness in metal prices has weighed on mining companies, which in turn has weighed on the index itself. So we can see here, we've moved sharply lower in the last couple of days. We've now fallen back to a level last seen in late-ish May. So we're now talking, 10-day, 2-week low, which itself is fairly significant. Looking at the MACD indicator, we can see a steady increase in negative momentum. So not only are the bears in control, they're actually they're actually becoming more and more in control as the session moves on. So momentum is clearly with the sellers. But what's interesting is this. Speaking of, using an indicator to potentially, how would you use an indicator? The RSI is moving lower, and it's not too far away from the oversold territory. Now, the last time we got close to being oversold was this period here in mid-May. You can see what the line is. It moved sharply lower here, and then it rebounded. Notice how that coincided with the price rebounding. So in the near term, this could be an indication that although we're moving aggressively lower, this could be the point where the market has a bit of a rebound and actually moves higher again. Maybe it will, maybe it won't. But with the way things are looking price-wise and in terms of RSI-wise and MACD indicator-wise, I think in the short term, at least the next few hours, or Friday and possibly Monday, I suspect we'll continue to see further losses. We could look to retest 47, change it around, 74.27. We could be targeting 74.27, and a break below that could see us back down towards 73.28. Now, once again, you always have to be looking at the bigger picture. In the short term, it's clear we've seen a lower low, a lower high, a lower low, a lower high, a lower low. And now we've fallen to a 10-day low or a 2-week low. But this short-term bearish move here needs to be put in the context of how much ground we rallied between mid-May and early June. So the market rallied from the lows here to this peak here. We saw a rally of about 420 points. So you can't turn around and say, oh, come on now, Dave, we're at a 2-week low, things are looking dreadful. Well, we rallied 420 points, and since then we've dropped 180, and 180 points as a percentage of 420 is about 40%, or probably even less than 40%. So it's not really a huge surprise to say the market has handed back 180 points after it rallied 420 points. So this is what I mean about always looking at the bigger picture. Typically the longer term trend wins out over the short term trend. Not to say that the short term trend can't last a bit longer, or who knows, maybe the short term trend will turn into a new trend, but more often than not, the longer term trend wins out. So and if we do see a rally from here, the area that I'll be first and foremost looking towards is this peak here in at 75.74, and then beyond that, I'll be looking toward this, the multi-week high that was set here at 76.46. An individual here is asking me about gold. I'll happily look at gold in 1 second. I'll come on now. I'll come on to euro dollar. Sorry, dollar yen is what I'll take a look at. And then after dollar yen, I'll recap gold quickly, and then after that, I'll look to wrap things up. Unless, of course, anyone else has any of the markets you want me to take a look at. So dollar yen has been in an absolute boom recently. The prices, the highs we've set in the last 12, 24 hours have been 20-year highs. The highest level seen since the millennium. Really, the early 2000s. So for me, that tells you everything you need to know. It's in a strong upward trend. While we continue to hold above these 3 simple moving averages, I suspect the upward trend will continue. Rallying from here, I could be looking up towards 136, 138, and then of course 140 will be the next big number to watch out for on dollar yen. What's going on? Well, earlier this week, it was confirmed that the Japanese economy contracted by 0.1% in the first quarter of this year. Now, keep in mind, 2 consecutive periods of negative growth is the definition of a recession. If we've already had 1 period of negative growth, what's the second quarter got in store for us? So there's already kind of fears, is Japan teetering on a recession? What's also going on is a strong US dollar. The dollar has been doing fairly well across the board recently. In mid-May, the dollar hit a 5-year high. Then had a bit of a pullback, and then the last 2 sessions, and particularly in this week, it's had a bit of a rebound. Now the dollar isn't as strong as it was in mid-May, but speaking about the dollar in general, but the dollar as a whole, the last week or so has been fairly strong. Hence why we're seeing dollar yen hit a highest level in over 20 years. Now, this is also something about using indicators to potentially enter a trade. For me, I'll be looking at this and going 20-year high set on the price. That tells me that the market's strong. If you look at the price action recently, higher high, higher low, higher high, higher low, higher high, higher low, all the way up. So as you can see in the last few weeks, buying in the dip has been a popular strategy. So therefore, that's a strategy I would probably want to go for again. If I am going to buy into the market, where am I going to buy into it? Well, I'll be looking towards this moving average here, the 20-period moving average. You can see here it acted nicely. It acted resistance several times all along here if you follow it around. It used to act as support here in late April, same in early May, and if you follow it around since then, and quite a few times, it's acted as resistance. So as I often say, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So if we do drift lower from here, we could potentially find support in around 133. Also, it's worth noting the 20-period moving average sort of coincides with this peak that was set here. So the market used to be powering ahead. It ran into a bit of resistance here. It pulled back ever so slightly, had a bit of a breather, and then it continued to move higher again. So some people out there will pay lots of attention to moving averages. Some people out there will pay lots of attention to kind of resistance points or consolidation zones. So when you have those 2 forces combined, it makes that price metric all the more important, because some people out there don't care about consolidation zones, but they do care about moving averages. Others out there care a lot about moving averages, but they don't care about resistance zones. So they kind of merge together, because I wouldn't be surprised if you had buy orders placed below the market in around these levels, in around 133.20, 133.00. So that's the sort of thing which is what some people often could say about charting and technical analysis. It can be a bit of a self-fulfilling prophecy. Anyways, if we do break below the 20-period moving average, where could potentially go below that? Well, potentially down towards the recent low here in around 132.31. So this entire zone here could act as an area of support. What does kind of interest me is that the price continues to be, if you look at the price action here in the last few hours is moving higher. But if you look at the MACD indicator, momentum is moving the opposite direction. So the divergence between the two tells me something's up. That this could be an indication that a change in trend is in the offing. Now, there's no guarantees that that's the case, but it could be. We've also seen a retreat in the RSI. It used to be heavily overbought, and now it's actually moving a bit lower. So it is possible that we could be in for a bit of a retreat here in the RSI, and therefore a bit of a move to the downside in price as well. I will look to cover gold again. I'll run through it quite quickly because I already mentioned it at the beginning of the video, or the video of the webinar. If there are no other questions after gold, I'll look to wrap things up. But feel free in the meantime to ask away. What's going on with gold? The strong US dollar. Gold is sort of caught in a difficult position. The strong dollar has been putting downward pressure on gold, but at the same time, the weakness in stock markets has been putting upward pressure, has been helping gold. So gold is typically seen as a flight to quality. Whenever stock markets fall, people usually swap their share investments for gold. And but at the same time, if ever the US dollar is very strong and it's rallying, that makes gold more expensive to buy and usually puts downward pressure on gold. So the rise in bond yields is getting investors to question, why should I have so much of my investment portfolio in stocks? Bond yields are now yielding 3% in the US or almost 2% in France. Why should I have so much money in stocks? And therefore stocks are falling. When stocks fall, it makes gold more attractive. But at the same time, the strong dollar is keeping a lid on gold as well. So that's why we're seeing the metal trade within this fairly small range. As I've said already in this update, the medium-term trend or the longer-term trend tends to win out against the short-term trend. So the short-term trend for gold is clearly lower. So we've retreated from a recent peak. We're kind of halfway between the recent peak and the recent trough. We've seen a peak here. We're not really seeing much in the way of new lows, but if I had to pick a side in the short term, it seems to me as if the short-term trend for gold is lower. But you can't ignore the fact that the much longer-term trend, the trend that's been in place for about 3 weeks now, is clearly higher. So if the broader, if gold continues to hold above, this trend line here, which is only a tentative trend line because it only has 2 points, you need to have at least 3 points to be a confirmed trend line. While we continue to hold above this trend line here, and while we continue to hold above 1828 in general, I suspect the longer term uptrend will continue. A rally from here could see it retest 1873, the recent peak, and if we break above that, that'll be fairly significant because you then be creating, like a 1-month high or a 5-week high. If we break above 1873, we could then be targeting this zone here at 1892. On the downside, like I said, the short-term trend is lower. If you do break lower from here, I'll be looking down towards 1828. And then if you break below that, it will be then looking towards 1810, and then below that again, down towards 1800. The moving average, good question. Is it exponential? Is it simple, or is it weighted? It's a simple moving average. It's a simple moving average. Yes, it's an SMA, a simple moving average. And to be fair, I just do that because I keep it simple. Yes, I fully see the logic behind using, say, exponential or weighted, because the price action that happened most recently you'd imagine would have the most influence in it, and it can be structured in a certain way. But to keep it nice and straightforward, the simple moving averages are the ones that I use. And just to reiterate, I'm using a 4-hour chart here. It's the 20-period moving average, the 50-period moving average, and the 100-period moving average. Last question of the evening, I'll come on to AUD USD. So a few minutes ago, I talked about how metal prices were weak. We've had the likes of the OECD and other big, and the World Bank and the IMF in recent weeks and months talk about lower growth. Even today, we had someone from a spokesperson for the IMF come out stating the IMF have already downgraded their global growth forecast for this year in April. There's talk of them doing another downgrade for global growth in the next few weeks and months. So that's weighed on metals. I already talked about how the sell-off in copper, silver, platinum, palladium, and the likes impacted mining companies. Well, it's also impacting the Australian dollar because Australia has a relatively large and fairly big commodity sector within its economy. So when metal prices fall, that typically pushes the Australian dollar lower. Conversely, whenever metal prices are booming, that typically pushes up the Australian dollar. So I've talked about on a previous chart how the US dollar itself has been rebounding the last few days. So it's a kind of a lose-lose combination. AUD USD is in the red for two reasons. First of all, the first component, the Australian dollar itself, is weak because of weak metal prices. And second of all, the US dollar is strong. So it's kind of a lose-lose for the AUD. So we can see here the AUD USD. So we can see here, a lower low, a lower high, a lower low, a lower high, a lower low. We're moving aggressively lower. We're below all 3 simple moving averages. We're back down to a level last seen in late-ish May. So we're back down to kind of a 10-day, 2-week low. The RSI is moving lower. MACD indicator is showing us that momentum is firmly in negative territory, suggesting the bears are in control. If we continue to hold above these 3 simple moving averages, I expect the medium-term bearish trend will continue. Moving lower from here, we could target 0.7093, and a break below that could see us down towards 0.7034. The RSI is moving lower. It's not quite in oversold territory yet, but it could be. And the last time we got close to or moved into oversold territory was at this point here in mid-May. We can see, and that coincided with the market rebounding. Once again, there are no guarantees that if you move into oversold territory, you're automatically going to rebound and you're going to completely have a huge rally just like this. But that's something to be mindful of. We might do. If you do see a rally in AUD USD, because even though the short-term trend is lower, we can't ignore the fact that much longer-term, medium-term trend is higher. If I do rally from here, I'll be looking up towards 0.7282. And then beyond that, up towards 0.7312. I'll very briefly take a look at CAD yen, and then I'll just wrap things up because I'm conscious of the fact that it's now, well, I know I started late, but I'm conscious of the fact that I've been speaking for well over half an hour. CAD yen. So not too dissimilar to dollar yen. A while ago, we looked at dollar yen, and dollar yen was absolutely booming. Hit its highest level in over 20 years. Concerns about a recession in Japan, strong US dollar, very similar price action. CAD yen. What's going on? Well, the Canadian economy is having a decent rebound. Canada is a very strong oil exporter, and the oil market is very strong. Oil has recently hit 3-month highs. So oil is strong, and the Canadian and the Japanese yen is weak. So no surprises here that we've seen an absolute boom in CAD yen. In fact, we're back up the levels last seen. We've managed to clear the highs of 2015. So we're back up the levels last seen a long time ago in CAD yen, possibly even about 15 years. Yeah, I think we're back up the levels last seen in about 2006, 2007 on CAD yen. CAD yen, so therefore it's absolutely flying. It's in a very strong upward trend. We obviously had a bit of a pullback, and notice how we've pulled back ever so slightly below the 20-period moving average, but not really a huge amount. If you follow that moving average around, you can see it acted nicely as support here, sort of, not quite, but on a few occasions, sort of acted as resistance. Not a perfect example of it. Acted as resistance here, resistance here. It doesn't have great form for regularly acting as resistance or support, but it appears to be acting as a bit of support for now. The RSI is moving lower, indicating that price bias is at the downside. The MACD indicator is firmly in the red, suggesting the bears are in control. For me, the longer term uptrend is likely to kind of win out. So therefore, buying the dip could continue to be a popular strategy, because it's clearly been a popular strategy all the way along up here. If we do continue to rally from here, I'm looking towards 108 109, and then of course 110 will be the next big one to watch out for. If we do have continue to, if this short-term downtrend does continue, where can we target? Well, I've been looking down towards the recent lows here from this kind of trough here in around 105.20, and then perhaps up towards this area here, this peak here around 104, 104.10. You know, it sort of coincides with the 50 period moving average. If you follow that around, you can see once again act as support, resistance, resistance, resistance. If you follow it around on a few occasions, the 50 period moving average was acted as both support and or resistance. I'll look to wrap things up there because I've been speaking now for exactly 40 minutes. For any of you who are on Twitter, feel free to get in contact. Feel free to get in contact. My Twitter handle is at @dmadden_equity, at DMADDEN_EQUITI. Obviously, I can't give you any advice, and I won't give you any advice. But if you were to kind of come on to me and say, "Oh, what do you make of CAD yen or whatever?" I could happily respond to you, put up a chart, and say, "This is a prevailing trend. This is if the trend continues, it might." Target A or B, or if the trend reverses, it might target X or Y. So feel free to get in touch at @dmadden_equity. I'll look to wrap things up there because, like I said, I've been speaking now for over 40 minutes. Feel free to tune in this time next week, next Thursday. I'll be back once again with my Scan the Markets webinar. So I'll look to sign off. And before I sign off, once again, for those of you who were here, who were live at the very beginning, once again, I do apologize. I had a technical issue which prevented me from starting on time. But overall, I hope it wasn't too much of an inconvenience, and I hope overall you enjoyed the webinar. Thanks again for tuning in, and a particular thanks for those who asked a few questions. It's always much nicer for me whenever I get asked a few questions, particularly something like CAD yen, a currency pair I don't look at very often. So I'd like to sign off now. Everyone have a good evening, and I will speak to you next week. See you later.